Welcome back. This morning, durable goods was reported to have declined in the month of February by 1%, in part due to falling production in automobiles and planes. The core durable goods, which excludes transportation items and other more volatile components of the durable goods, that remained unchanged. Now, again, the durable goods are high-priced items that typically last more than 3 years. When we think of durable goods, we think of home appliances like washing machines, furniture, also cars and trucks, defense products as well. Now, taking a look at durable goods, we see here the yellow line is the S&P 500. This is going back to 2013, so this is a very long-term picture of what the correlation looks like between durable goods and the S&P 500. Durable goods are in green, and we can see it does not move, for the most part, it does not move that much, but it tends to have a positive correlation to the S&P 500, but it is certainly connected to specific sectors within the economy. Again, durable goods, we also like to think of this as being very closely correlated to the housing market, because when people buy new homes, they obviously buy new home appliances, and also construction equipment falls in that category. Notice a very big downturn in 2020 in the S&P 500, and durable goods both have recovered to a great extent. Recently, though, this is again, I believe, the fourth consecutive monthly decline for durable goods, which does really correlate with a weak S&P 500 as well. We take a look at durable goods in green and durable goods excluding transportation in yellow, and we can see that when you take out the transportation, the number looks a little bit better. Again, this report today demonstrated that one weak area of the durable goods report is transportation, automobiles and planes. The following yellow line here only shows transportation, only the transportation segment within durable goods, and we see that is very much declining and is taking a really significant move to the downside, which explains, I think, in part why we see so much weakness in stocks lately as well. Here we see durable goods excluding defense in yellow, and then the overall durable goods in green. We can see a very close correlation. There really isn't very much variance between the two. So the big volatile component definitely looks to be transportation and not so much defense. Here are the durable good defense components overlaying the S&P 500, the S&P 500 in green, defense in yellow. It looks like there was a little bit of a waning in the defense spending, but it looks like it's picked up and it's matching the S&P 500 progress. We see here, this is the personal consumption expenditure. Think of this in terms of the inflationary component of durable goods, meaning how much do these durable goods cost? And we overlay that with the standard PCE that we talk about when we talk about inflation. So the standard PCE, personal consumption expenditure, is green. The yellow line are the durable goods orders reflected in terms of PCE, and we see that the prices for the durable goods in part of inflation was actually much higher, but it looks like the two lines are now intersecting, which kind of makes sense because you take a look at a year, 2 years back, the housing market, at least on the surface, appeared to be a lot stronger than it is now. So when we see a strong housing market, we also tend to see a strong durable goods PCE. But now, one of the strongest parts of the economy over the past couple of years, the housing market, as that continues to wane, I think that the PCE, the personal consumption expenditure component of durable goods, is falling. So this chart makes a lot of sense. And then finally, we can compare durable goods in blue to Whirlpool. Whirlpool is, obviously the company that makes washing machines and home appliances. Now, this is not at all any type of stock recommendation, but very simply to demonstrate the correlation. Now, again, every stock is correlated to many, many different factors. So Whirlpool moves with the S&P 500. It's sensitive to interest rates, and there's also very company-specific things going on as well, like any stock, any company out there, any publicly traded company. So we don't expect to see a perfect, correlation here, but we can see over time the durable goods orders over the past about 6 months, actually about more than 6 months, about 18 months or so, was trending to the upside. Meanwhile, Whirlpool was selling off. Maybe the stock market, acting as a forward looking mechanism, looking at the expectation of higher interest rates, maybe that stock started to go down first. But it looks like now the durable good orders seems to be chasing the stock down. So this again, the stock market, I think, tends to act a little bit more like a forward-looking mechanism because the durable goods orders just very basically looks at the number out there that's reported within the economy. But stocks move in anticipation of these numbers. Stocks move because we buy and sell these stocks. So certainly would expect the stock market to move ahead of durable goods. But if we start to see in the following month's report a continuation to the downside in durable goods, well, I probably would not be very optimistic for those stocks. For example, like Whirlpool, and in the future we'll talk about some of the other stocks that are most closely correlated to this particular economic figure. We hope this has been helpful. We look forward to seeing you back soon.